stop. Before you buy another stock, you need to hear this. You're spending hours researching stocks, watching market news, trying to time your trades. Meanwhile, millionaires are doing something completely different, and it's responsible for 90% of their wealth while your strategy accounts for maybe 10%. Think I'm wrong? Stay till the end of this video. If I haven't changed your mind, roast me in the comments. Hit subscribe. You're about to learn what they don't teach in school. Here's what most people get wrong. They think wealthy investors win because of what they know. Wrong. It's about how they think. Let me show you the 5 mental traits that separate millionaires from everyone else. Long-term vision. They think in decades, not days. While you're panicking over a 5% drop, they're asking, where will this be in 10 years? When the market crashes, they don't see disaster. They see a sale. Ask yourself, how many times have you sold in fear, only to watch it skyrocket later? The wealthy train themselves to ignore that panic button. Abundance thinking. They believe wealth grows. It doesn't shrink. Most people think money is a pie. If you get a slice, I get less. Millionaires see it differently. They can bake more pies. This shift alone changes everything. Scarcity makes you scared. Abundance makes you strategic. Emotional control. They feel fear. They just don't obey it. Fear and greed destroy more portfolios than market crashes ever will. The wealthy don't ignore emotions. They override them with rules and systems. It's like having a plan when everyone else is running in circles. Quick adaptation. They fail fast, learn faster, and move on. Markets change. Technology disrupts. What worked last year might be worthless today. The wealthy don't cling to old ideas. They evolve constantly. Iron discipline. They have rules. They follow them, always. This separates winners from wannabes. They rebalance on schedule, not based on feelings. They write down their rules and stick to them even when it feels totally wrong. Okay, enough psychology, let's talk money. What are they actually doing with it? Here's something that blew my mind when I first learned it. Where you put your money matters way more than what you pick. Let me explain. Studies show that 90% of your investment returns come from how you split your money across different types of investments. Only 10% comes from picking individual stocks. Think about that. All those hours researching the next Tesla or Bitcoin, that's just 10% of the game. The real secret, it's about building the right mix. So what does a wealthy investor's portfolio actually look like? They start simple: stocks, bonds, real estate, some gold, and cash. Nothing fancy yet. But here's the game changer. They don't just buy stocks in their own country. They spread their money across the entire world. America, Europe, Asia, everywhere. Why does this matter? When the US market drops, maybe Japan's market is going up. When Europe struggles, emerging markets might be booming. By owning pieces of the whole world, they protect themselves. It's like not putting all your eggs in one basket, but on a global scale. The private market advantage. But here's where it gets interesting. The real differentiator isn't what they buy in public markets. It's what they buy in private markets. Private equity, private credit. These are companies and deals that aren't on any stock exchange. They're not available to regular retail investors. And historically, private markets have crushed public markets in terms of risk-adjusted returns. We're talking consistent outperformance over decades. Now, here's what's wild. They're using AI-driven tools to manage all of this dynamically. The technology is watching their portfolio 24/7, automatically rebalancing, optimizing for their specific risk tolerance and tax situation. But wait, there's a whole other category we need to talk about. When you hear alternative investments, you probably think, oh, that's for billionaires only. And look, traditionally, you'd be right. But that's changing faster than you might think. Here's what the wealthy are actually investing in. Hedge funds. These are private investment pools that use advanced strategies to make money in any market condition. They can profit when markets go up and when they go down. It's not about market timing. It's about sophisticated positioning that most retail investors never see. private equity, and venture capital. This is where investors buy stakes in private companies that aren't traded on public stock exchanges. Think of it as owning a piece of a business before it becomes the next Apple or Uber. Imagine getting into Facebook when it was still in a garage. That's the opportunity here. Real estate and REITs. Beyond just buying rental properties, real estate investment trusts let you invest in commercial properties like shopping malls, office buildings, and apartments without actually buying the buildings yourself. These provide steady cash flow and protection against inflation. Collectibles. Physical assets like fine art, rare wines, vintage cars, and luxury watches that tend to hold or increase in value over time, completely independent of stock market movements. Why? Because these assets move on their own track. When stocks crash, a Picasso doesn't care. The tokenization revolution. But here's the newest frontier that's absolutely exploding right now. Tokenized assets. Blockchain technology is making it possible to own a fraction of things that were previously indivisible. Want to own $500 worth of a $50 million commercial building? Done. Want to own a piece of a Basquiat painting? You can do that now. This is democratizing access in ways that have never been possible before, and we're just at the beginning of this trend. But owning great assets is only half the battle. Let me show you how the wealthy amplify everything. Wealthy investors use two incredibly powerful amplifiers that most people either completely ignore or catastrophically misuse: leverage and taxes. Let me break both of these down. Strategic leverage. First, leverage, using borrowed money to invest. Now, before you freak out, understand this. The wealthy aren't maxing out credit cards to buy meme stocks. They're using controlled, calculated leverage with strict risk management on high-probability opportunities. Think of it like this. If you're confident an asset will return 12% and you can borrow money at 4%, that spread is profit. But you only do this with careful position sizing and clear exit plans. The tax optimization machine. Now, taxes. This is where they really separate themselves. Let me show you why this matters with simple math. Say you want to take home $100,000 after taxes to buy a house, fund your retirement, or whatever your goal is. That's your actual money you can spend. But here's the catch. How much you need to earn depends on your tax rate. Investor A pays 30% in taxes. To take home $100,000, they need to earn $143,000. Why? Because $143,000 minus 30% in taxes, $43,000, leaves them with $100,000. Investor B pays only 15% in taxes. They only need to earn $118,000 because $118,000 minus 15% in taxes, $18,000, leaves them with the same $100,000. Both investors end up with the same $100,000 in their pocket. But investor A had to earn $25,000 more to get there. That's $25,000 of extra work, extra stress, extra hustle, just to end up in the exact same place. Now imagine this happening year after year. Over 20, 30, 40 years of investing, we're talking about hundreds of thousands, maybe even millions of dollars disappearing to taxes that could have been legally avoided. Here's how it adds up. That $25,000 difference we just talked about, if you invested that money instead of paying it in taxes and it grew at 8% per year for 30 years, it would turn into over $250,000. Now multiply that by every investment decision you make over your lifetime. Every stock sale, every dividend payment, every capital gain, all taxed at different rates depending on your strategy. The wealthy pay 15% while the average person pays 30% or more. That gap compounds into massive wealth over decades. That's why tax optimization isn't just a nice to have. It's the difference between retiring comfortable and retiring wealthy. So what are they doing? Here are the 4 main tax strategies. First, they use special accounts where money grows tax-free. Think retirement accounts and trusts. Your money grows, but the government doesn't take a cut until much later, or sometimes never. Second, they control when they pay taxes. If they have a low-income year, they sell their winning investments and take the profits. If it's a high-income year, they hold on to those winners and wait to sell them in a future year when their income is lower. Third, they sell their losers on purpose. Sounds weird, right? But if you sell an investment that lost money, you can use that loss to cancel out taxes on your winners. It's completely legal and saves thousands. Fourth, they plan ahead for passing wealth to their kids. With the right planning, your children can inherit your wealth with minimal taxes eating into it. Bottom line, this isn't about cheating, it's about playing by the rules smarter than everyone else. But making money is only half the battle. Keeping it is the other half. Here's a scary fact. If you lose 50% of your money, you need to make 100% just to get back to where you started. That's why wealthy investors are obsessed with three things. 1. Spreading money across investments that don't all move together. When stocks fall, something else in their portfolio goes up. 2. Buying insurance for their portfolio through special financial products. It costs money, but protects them when markets crash. 3. Keeping cash ready. When everyone's panicking and selling, they're buying everything on sale. They also use technology to test how their portfolio would handle worst-case scenarios, so they're never caught off guard. Now let's talk about what's happening right now in 2025. The investment landscape is being reshaped by four massive trends right now, and the wealthy are already capitalizing on all of them. Trend number 1, AI dominance. Artificial intelligence is eating everything. We're not talking about basic robo-advisors anymore. This is sophisticated AI that predicts market movements, optimizes tax strategies in real time, manages risk dynamically, and does it all faster and better than any human ever could. The wealthy are gaining compound advantages through better data and better analysis, and this gap is widening every day. Trend number 2, tokenization explosion, blockchain and asset tokenization. I mentioned this earlier, but it's accelerating exponentially. Real estate, art, private companies, intellectual property, everything is being tokenized and made fractionally investable. This is creating liquidity in historically illiquid markets, and it's opening doors that were previously locked to 99% of people. Trend number 3, private market migration, the great migration to private markets. Public market returns are getting compressed. More regulations, more competition, more algorithmic trading. The smart money is flowing into private equity, private credit, and direct deals. Wealthy investors are increasingly bypassing public markets entirely for significant portions of their portfolio. Trend number 4, ESG becomes mandatory. ESG stands for environmental, social, and governance. It's a way of evaluating companies based on how they treat the planet, their people, and how they're run. Now, wealthy investors aren't doing this just to feel good. They're doing it because companies with poor ESG scores tend to face massive problems down the road. Lawsuits, government fines, scandals, boycotts. Think about it. A company that pollutes heavily will eventually face regulations. A company with terrible labor practices will deal with strikes and bad press. A company with corrupt leadership will implode. ESG is about spotting these risks before they blow up. It's becoming the standard way wealthy investors evaluate which companies are actually built to last and thrive over the next 20 years. Now, here's the question you've been waiting for me to answer. Okay, this is all great, but I don't have $1 million. What can I actually do? Perfect question. Here are 6 concrete actions you can implement starting today. Action number 1. Diversify intelligently. Start with low-cost, diversified funds. ETFs, or exchange-traded funds, are baskets of stocks that you can buy and sell just like a single stock. They let you own hundreds or thousands of companies with one purchase. You don't need $1 million to achieve broad diversification. A few $100s in a total market ETF gives you ownership in thousands of companies globally. That's the same core strategy the wealthy use, just scaled to your level. Action number 2. Access alternatives. Use fractional alternative platforms. REITs, or real estate investment trusts, are companies that own income-producing real estate like apartments, offices, and shopping centers. When you buy shares in a REIT, you're essentially becoming a part owner of these properties without having to buy buildings yourself. REITs give you real estate exposure without buying property. Tokenized asset platforms are opening up access to alternatives that were previously impossible for retail investors. The barriers are dropping every month. Action number 3. Automate everything. Set up systematic automatic investments. SIPs, or systematic investment plans, automatically invest a fixed amount of money at regular intervals, like weekly or monthly, taking emotion completely out of the equation. Whether it's through SIPs, dividend reinvestment plans, or automatic transfers, make investing mechanical. Remove emotion from the equation entirely. The wealthy do this at scale. You can do it at your scale. Action number 4. Optimize your taxes. Max out every tax-advantaged account available to you. Retirement accounts, education savings plans, health savings accounts, whatever applies to your situation. The tax savings compound dramatically over decades. This is free money you're leaving on the table if you're not doing it. Action number 5. Build your system. Create written rules for your portfolio and follow them religiously. When will you rebalance? What triggers a buy or sell? Write it down. Follow it even when your emotions are screaming at you to do something different. This single habit will put you ahead of 90% of investors. Action number 6. Never stop learning. Commit to continuous financial education. Markets evolve. Tax laws change. New opportunities emerge constantly. The wealthy are voracious learners. Read, watch, study, experiment. Make it a lifestyle, not a phase. Here's the beautiful truth. The gap between wealthy investors and average investors is shrinking every year. Technology is democratizing access. Information is freely available. The question isn't, can you do this? The question is, will you? So here's the truth about wealthy investors. They don't have a secret formula. They have a system, the right psychology, smart asset allocation, careful risk management, and ruthless tax optimization. But here's what matters most. You don't need millions to start investing like them. The strategies we covered today, you can begin implementing them this week. Start with one action. Maybe it's opening that tax-advantaged account. Maybe it's setting up automatic investments. Just start. Because wealth isn't built overnight. It's built through small, smart decisions repeated consistently over time. If this video opened your eyes, hit that like button and subscribe for more financial deep dives. Drop a comment. Which strategy are you trying first? Thanks for watching. Now go build your wealth.